Governor, a shift, your confidence seems to be growing, you've got a firm eye on the tightening process. What's changed?
Well, I think as time goes by, we are more confident about the recovery in terms of activity. Actually, our view on the recovery, on activity and recovery hasn't changed much since May, actually, in terms of economic activity. One reason for that is that the impact of COVID on economic activity has attenuated and reduced as time has gone by. So when we see the sort of successive waves, we see that the economic impacts have reduced over time, and that gives us, I think, greater confidence about the path of the economy. But I can't underestimate. There's still a lot of uncertainty around in the world economy and the UK economy.
You talked today a great deal, certainly in the briefing, about how you want the process of the unwind of the balance sheet to be predictable. You use that word time and time again. How confident are you that you can start the process, complete the process of the unwind without causing market turbulence, without causing an unwarranted tightening of financial conditions that such a tantrum, let's call it that, could cause?
Well, we emphasise that we plan to start with ceasing to reinvest as gilts that we hold mature. And I think that is the best way to start, with greater assurance, as you rightly put it, over the impact, and that the impact will be understood and therefore won't cause disturbance, because the markets, of course, will be able to see. That's transparent. We're very transparent about what we've got, what we hold, when it matures, and therefore the flows, as it were, that will result once we start with the no reinvestment policy. So I think that's a sensible policy. Now, of course, it's also a much more gradual reduction in the balance sheet than you could hypothetically at least get from active sales. But I think that's the right place to start. The other thing that I would say that we emphasised today is that, of course, when we talk about the whole process, I would emphasise this point that we're not going to be selling the whole stock, because the level of reserves demanded by the banking system now is higher than it was pre-financial crisis, and you have to go back there to get before, obviously, the beginnings of quantitative easing. So we don't know, because it's going to be very state contingent and judgmental at the time, when we will hit that steady state. But we do know that it will be quite a lot higher than where we were before QE started.
Let's talk about where pricing is currently. Alan Posen was talking to Rich Clarida earlier on this week, the Fed Vice Chair. And in that conversation, Rich Clarida talked about his surprise as to where the Treasury curve was, how flat it is, how low yields are. When you look at the gilt curve, do you share his surprise as to where pricing currently is?
I think if you come at it, and I think this was probably where Rich Clarida was coming at it through the lens of saying there was quite obviously quite a marked response, particularly in the US, to the Federal Reserve's communications going back a few months now, back to around May time. And then it sort of flattened off and came back. Now, if you look at it through the lens of news on inflation, you say, well, really? How do you get there?
Yep.
I think we should.
Is that your surprise?
Well, I would share Rich Clarida's puzzle at that point. I mean, if that's the only lens you look at it through. Now, I mean, you have to then ask yourself the question: is the market taking a different view on growth prospects? I mean, is it saying we're just not as optimistic about growth prospects? I think then you have to start, saying, well, are they assuming things about further waves of COVID, for instance? Yep. Spread of the Delta variant. I don't know whether they're doing that or not, because we don't sort of get. We can't sit them down and quite extract that from them. You have to take those sorts of views. Now, what I would say, however, is that, of course, it is consistent, certainly from our perspective, with the view that the hump in inflation will be temporary. Now, that is broadly consistent. So that to us is a point of consistency. But no, I mean, like Rich Clarida, we've sat in here and said, well, okay. Don't quite see where the news is there.
Well, let's talk. You bring up inflation, so let's talk about it. You have significantly upgraded where you think the peak is going to be.
Yeah.
You do then see it falling back towards target.
Yes.
Given the scale of that revision, how confident are you in the shape of how inflation is going to develop? Is it possible that we could see a number of prints above 4%? I guess what I'm really asking is kind of what is your tolerance for above target inflation over a significant period? I'd be interested to kind of get a little bit specific here?
Well, for me, the issue is this: we've got as I would describe as a sort of hump in inflation, and it goes up to, as you said, around about 4% at the peak, around about late final quarter of this year, first quarter of next year and of course a lot of that is, we can see it coming now in the sense of price effects that are either built in, base effects type things, annual base effects, or sometimes administered price increases that we can come in. We know tomorrow there's going to be an announcement on energy price caps in this country. Don't know what it is, but we know it's going to happen. So those sorts of things you can see. For me, to be very precise on your question, I mean, the big issue here is inflation expectations. And of course, that gets us to the question is, are we going to see second round effects? Are we going to see it built into wage bargaining? Are we then going to see this becoming more persistent? And of course, that's where we have to act. Yeah. I say to people, monetary policy can't solve a world shortage of semiconductor chips. I'm afraid that's not something we can do. We can't solve that problem. The key question is, do all of those things feed through into second round effects which cause sustained inflation? And we have to act. And that's why we've very clearly signalled today that of course we will act.
Yep. Okay, well, let's talk about the labour market. You bring it up, you talk about semis, but let's talk about wages. When do you think you're going to have enough information on the impact of the roll-off of the furlough? Is it going to be the beginning of next year to make a decision on what is going to happen with the labour market? You've slightly improved the outlook today, but when do you think you're going to have solid enough data to make some sort of accurate predictions?
I mean, the furlough scheme comes to an end in September, so I think we will have information on the furlough scheme, building up through the rest of this year, because it's now got a pretty short remaining life to it. There are other elements of this story, though. There has been an increase in inactivity in this country. That's of course that's not a judgment on people. That's a statistical term. That's people who don't have a job and aren't searching. Quite an increase, as I mentioned in the conference we held earlier, are in the number of people deciding to remain in full-time education. That's not uncommon in this country and when we have recessions, but obviously we need to see them come into the labour market when they decide to end it. Now, I think there's good reason to think that will happen, by the way. I don't have a reason to think it won't happen, but we will build up the picture of is it happening over time, but we'll see quite a bit by the end of this year, I think, actually.
One final quick question, a bit off topic. What is the bank's current view on removing the bank bonus cap post-Brexit?
Well, everybody can look up comments I've made in the past on the banker's bonus cap. It's not a policy that I thought was the right way to address the incentives in bankers' remuneration. But I can tell you there is no current plan to do it. There's a lot of reviews going on elements of regulatory policy. It's not one we're currently reviewing. So no current plan is the best way of addressing that question. But it remains the case that I don't think it's the best way to address remuneration, but we've got a lot of priorities on that front, and it's not currently a high priority.